All right, you guys, this is being recorded, and of course, those of you that have been with me for a long time know I say that say this at the beginning of every webinar, hopefully a little bit smoother than that. Is watch this webinar again because some of the nuances might fly by you, especially if you're newer to options trading or even just newer to the way that I trade, because I come up with specific rules that you need to follow in order to implement something as easy as the short put. All right. Yes, that's probably one of the easier strategies to understand. Maybe the long call is the easiest, I don't know. But at the end of the day, very simple strategy, but there's a lot behind it before you can enter this strategy, okay? Before you want to put this to work with real money, okay? And I'll talk about all those reasons why and those rules as we go along, but let me get a couple of things out of the way real quick. My name is Ira Wilkinson. Some of you may recognize me as a Wolfman from CNBC, Fox Business, or the Wall Street Journal. I started trading in college with some money I'd earned, and then after graduating college, moved to Chicago and never filled out a resume and started working on the floor at the Board of Trade. And in that time, I've traded everything from stocks, financial futures, commodities, and currencies, options on all these products, basically, in just about every market condition. Any opinions, news, research, or analysis, or other information contained in this webinar should not be construed as advice. It's only going to be me trying to teach you different strategies that you can implement into your portfolios. It's up to you to understand your risk parameters, what's in your portfolio, and whether or not it will fit in your portfolio, okay? So do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. Follow me on Twitter at Wolfman's blog for all kinds of market snark and or hopefully some wisdom out there. I also, during earnings season, tweet out what my trades are, or if I cover something towards the end of the day, I'll sometimes tweet that stuff out too, so that you guys are that are keeping along with it can keep up. All right. And you can also follow our parent company at Pro Trader Strat for all kinds of deals and or market wisdom as well. All right. This is going to be on the short put. But one thing I want you to think right now is let's pretend we don't know about this. All right. We don't know we're doing the short put yet, because what I want to do is get to a place where we have a directional assumption. Okay. We don't know we're doing the put yet. We're doing a bullish assumption, and it's XYZ. I say, I'm looking at the chart, and all of a sudden the chart does this, and it looks like, hey, you know what? All of a sudden, I think we are going to start moving higher, all right? However you come up with your bullish assumption, I don't know. Maybe it was a Fibonacci here, or, the market broke down, and you got the point of control here, and you think the magnet's going to draw it back up, okay? However you come up with your directional market assumption, maybe you're just full on Apple, or let's say Apple, AAPL, since I said it. Apple comes up with a new product, and you play around with this little widget over here, and it basically does everything except for give you a shower, I guess. So you think it's going to change the world, and now you think Apple is going to be a buy. However you come up with that, a bullish assumption. I did that with Yoplait yogurt one time when they came out with the yogurt drinks. They were free falling. They came out with that drink, and I was like, I don't care what it is. I'm going to be buying that thing going forward. All right. So however you come up with your directional assumption, that's what we're starting out with here. So we've come up with a directional assumption. We still really don't know we're doing the put yet. All right. But essentials to success, picking the right underlying. I'm bullish in XYZ. So I'm going to pull up my platform. Give me a second here. Let's pull up the platform. Pull it over here. So I've come up with my directional assumption with XYZ. So I go over here to the option montage. And during open market operations, this rule does not apply after the markets close like we are right now, because when we have day orders in, those orders get canceled as soon as the market closes. So these markets won't reflect what I'm talking about here. But a stock over $100, XYZ, I'm bullish in. So when I come over here to the option montage, which is this page that has all the different months and everything else, I need to come over here and say the closest expiration, which is the spot month is what we called it. And it is the month that is the closest to 35 days to expiration, days to expiration. That is the spot month. That's where the volume and open interest, volume, not volatility, volume and open interest are, okay? That's where the eyeballs are landing. So we want to go as close to 35 days to expiration. That's the one we're going to be looking at for this rule. So a stock over $100, we need to go and move our decimal 3 ticks to the left, 1, 2, 3, and we come up with 19.5 cents, right? So we can call it 20 cents. So what we want to do is drop down here and look between the bid and the offer on these options with closest to 35 days to expiration, just outside the money, and make sure that falls in line with our rule, 20 cents to the bid offer during open market, all right? Any stock over $100, we move the decimal 3 ticks to the left. Now, if we're looking at a stock under $100 like Starbucks, my rule is it's got to be equal to or less than 10 cents wide, okay? So we want to make sure that these markets are really tight. And you can see even in the after hours, we've got that working out here with Apple. Apple is usually like 2 or 3 cents wide, but even in the aftermarket, when most people are canceling their orders, we still have a pretty tight market in there, and it fits that rule of less than 10 cents, okay? Trevor, hey, would this rule apply to SPY or ETFs? Yes, it does, absolutely. Even more so with ETFs because they have even more participation in them generally. So if you find an ETF that does not fit this rule, then I would stay away from it, because the problem is if we look at like Starbucks, we can see that we're going to have a lot of volume and open interest in these options that are trading closest to the at the money. You can see the further away we get it on a daily basis, they're not trading so much. But inside of about 10 delta, we're seeing a lot of participation going on. So that's what creates tight markets, because if I come in this market, you know, in Starbucks, and I put in a bid for 151 right here on these calls right here. Well, somebody else might come in and offer 158, all right, and tighten it up a little bit. Well, once somebody had that 159 offer, sees you're at 158, he goes, I'm at 157 now. I'll drop it by a couple pennies. I'd rather get, you know, the trade rather than to have that penny. So he offers it a little bit better, and then the market gets a little bit tighter, and so on and so forth. That's what we want to see. If it is a really wide market, say for instance, Starbucks was $76 wide, and let's just say that these options instead were, you know, a dollar bid at 125. So it's 25 cents wide, pretty wide. Well, I come in and I say, you know what, I'll pay a dollar. Let's just say I go up to $1.20. All right. I'm even better than what this market is. Well, this guy might not ever even move. He's just like, I'm the only cat in town, dude. You're going to have to pay 125 or nothing. All right. So in a robust market, free market price discovery, just going full tilt, you would likely see this market get a little bit better because somebody wants to get filled. But in a really wide market, you might see the person just sit on their hands. They might not even be paying attention to that market anymore. They might be on to something else. So make sure that you're staying away from that. Is this IRA friendly? You know what? Actually, the short put is usually IRA friendly. Even if it's naked, it's usually going to have to be cash secured though, because they're assuming you're going to want to buy that stock to put it in your portfolio. And my rule of trying to limit that usually is just on the short calls, because it's not going to limit your the amount of money you have to put up for it to limit this risk on it. So play around with it. I'll tell you, Trevor, remind me when we start pulling this up how to put this in. When I start pulling up the platform to implement this strategy, remind me again, and we'll go through that a little bit better in more detail. But I'll talk about that here in a minute. So that's picking the right underlying. Ultimately, if it's less than $100 on the stock, we want to go less than 10 cents on the bid to the offer. All right, bid offer. All right, and if it's greater than $100, then we just move the decimal point 3 ticks. 1, 2, 3. Okay? And that's how wide it should be. Pretty simple on that one, right? So now we know XYZ is a good underlying to trade with our bullish assumption, right? Now I have a bullish assumption. I still do not know that I'm going to be implementing the short put, but we're getting much closer, all right? Right now, I don't know that we're implementing the short put, but I'm going to check the environment on it. And XYZ, I go over to the platform, and with XYZ, we just have up Starbucks right now. Let's just say I'm bullish in Starbucks, not that I necessarily am, but we need to know what the environment is. And when I'm speaking of the environment, I'm talking about implied volatility down here, okay? So what we need to do is we need to know where the current is, which is 23. We need to know where the high is, which is 35, and the low is 12. So we've got the high is 35, the low is 12, and the current is 23. All right, so that's the current. So what we do is we have a fraction here, and we take the current minus the low and take that sum and divide it by the high minus the low, and we'll come up with a fraction, or we'll come up with a decimal point. So right now we throw in 23 minus the low, which is 12, and then we divide that sum by the high, which is 35, minus the low, which is 12. So we've got 11 divided by 23. So you can see right now it's probably in about a 49 percentile. We go over here, it's 46. It's pretty close though, by just guessing, rounding everything off. So it's 46 is the right number. So for me, my rules on the environment, we need to have the implied volatility percent, which you can see I have listed right over here. Implied volatility percent listed from highest to lowest, because the implied volatility percent determines what kind of strategy I'm going to do. If it's above 50%, we are going to be selling premium generally. We sell premium. All right. And if it's below an IV percent of 50, then we're going to be buying premium. All right. So this one is below. So it's not really going to fit my rule here for getting that short put, because for me, the right environment, if we're going to do a short put, just a short put, the IV percent, my IV percent needs to be above 50. All right. Or when you're doing that math, it's going to come out at 0.50. You times it by 100. That's how you get your percent, right? So that one's a little bit low for this one, but one that I'm really itching to do is this Tesla. If you guys watch the daily market commentaries, you've seen me fumbling around with this one a little bit. Probably should remove this old drawing. Anyway, so we're looking at Tesla. Yes, I know all the stuff going on with Tesla. I've been bearish Tesla forever. Okay. I am actually starting to flip and feel a little bullish in Tesla just because everybody else is crying about it. So Tesla, if I go over here and do their IV percent, obviously if you don't have it on your platform, you can just do the same thing I did, 81, and then 110, and the bottom is about 40. So you come up with 59%. So IV percent is above 50. So in this, if I was bullish in XYZ, I know that the underlying during open market operations, the underlying is within 20 cents here, okay? I look for the environment. I see that the environment is showing me it's above 50. I can start selling premium in this strategy. One thing to note also, I go over here and look at where implied volatility is right now in this clean month where nothing is, really happening. There's no binary event like an earnings. And you can see our implied volatility is about as high as it gets for even an earning. All right. So that's pretty steep implied volatility. that's pretty heavy. We want to start selling premiums around that type of situation, okay? So this would be a strategy. I'm bullish in XYZ, let's call it. I see it has high implied volatility percent. I expect this volatility to come out about as quickly as it came in. As you can see, when you get those spikes in volatility, they have a tendency to come out as quickly as they came in. So I'm looking for volatility to come out, especially if my directional assumption is right and we start getting to move higher. So high implied volatility percent, I got a good underlying. So I'm looking at selling a short put. So with that being said, when I'm selling premium, I want to make sure that I'm taking advantage with the short put, a bullish assumption. I need that theta decay because we're doing a short put. I want that thief in the night. We used to call theta the thief in the night that would come and steal your premiums, okay? When you sold the premium, you want that guy to come in and take that premium away, right? Because then when you buy it back, it's much lighter in a sense. So we want that theta decay with a short put. We're leaning towards that because we know we need to sell premium when implied volatility percent for that underlying is above 50. So we're going to take advantage of theta decay. And I mentioned this. We're also looking for that volatility crush. I talked about this. We can see volatility ratchet up just like a chart. But one thing we notice with volatility is as fast as it comes in, we see it have a tendency to come out almost quicker, which is why we used to say it was the crush. That volatility would just implode on itself and you can scoop up some premium. If you guys are watching the daily market commentaries, you saw me trying to do a bullish strategy with Tesla just recently, right? I did a long call spread. Implied volatility percent was low. So that meant a premium buying strategy. Well, I was directionally wrong. I literally put it on the 21st. I didn't wait for it to get confirmed, which is one of my weaknesses. I have a tendency to get in a little early, and I saw this doji and I was like, I'm getting in anyway. And the next day, you know, after I got in, it flushed out. I said I was out right below 194.48. That's where I got out, kind of. I actually started putting this strategy on to get out. I was long, remember? The direction was going against me. And I actually got, when it came down to the lowest part of the day, I actually got filled from the point where I put it in when it was trading like I think it was like 196 even, just below 195. I put that strategy to close it because I was just like, this isn't going to work out. And as the market slammed, you can see from the onset of the day, volatility went from 65 and it actually went up to about 78, 79 in that day. So the direction went against me, but the implied volatility and the volatility coming into that strategy helped me out. I mean, it was still a loser, don't get me wrong, but you know, synthetically, I got out when the underlying was trading at around 198 when it was really trading, or 195 when it was really trading 193-ish at the time that I got out because that volatility really expanded for me. So when we're looking for that right environment, you know, we want low implied volatility. Like I got in down here when the volatility was relatively low and I got that huge spike up in volatility, even though I was directionally wrong. It helped me out. Again, now we have high implied volatility. I would flip to say it's the premium selling strategy because then when that volatility comes out, it will help me. And in that day, we can even look at the monthlies I was doing and look at the volatility from yesterday to today. I told you it was around 67. It's around 85. So let's just take the theoretical pricing of here and say, well, what happened if the market would have gone negative by, let's say, 13 percentage points? Because it increased 13 percentage points yesterday. So you can see that if those 13 points came out of it, the difference in the pricing, all right? So I got in mechanically with a long spread. And when the premiums did this for me on one day, you can see how that strategy would help me out, right? How these premiums inflating made this the price increase enough to come to my level despite the fact that I was directionally wrong. So when I'm talking about these implied volatilities, I say implied volatility is the most important metric to look at, all right? Volatility across the board. Because if you enter this strategy when volatility is low and it increases, you bought that strategy, it'll help you. Vice versa, we're looking at these short, Wrigley. Sorry, my dog is having a dream in the background. And when volatility is really high, we want to sell premium and have that premium come out of it. So that's what I would look for in a directional move here. I think that this market's set up to move higher. I would, if you have a lower risk tolerance, wait for this to get confirmed. I have a higher risk tolerance and lack of patience usually sometimes, and I usually have a tendency to get in a little bit earlier. And and you know, so if you have a higher risk tolerance and willing to do that, then you know, you don't necessarily have to wait to get it confirmed. But a good mechanical thing to do would be to stay in this and wait for it to get confirmed. Watch it closely. So for instance, let's just say I'm looking to do this. I would go over and look at these premiums, make sure that I expected volatility to increase for that. All right. Then picking the right duration. When we are selling premiums, we don't want to be in this for a really long time, because what can happen is the duration needs to be a little bit shorter, because we're going to look for this type of theta component. These are days to expiration down here. As you can see here, days to expiration. The further out in time you go, you can see that thief, the theta thief, doesn't come in to your lives very quickly. He may come in and steal a penny or a day or so. But once he gets down into here, he's probably still stealing a nickel a day, you know, maybe even 10 cents a day or something like that. But it's increased to that from out here where he's doing maybe a penny a day or 2 pennies a day. So we want that thief to steal our premiums because we're looking to sell puts. Well, if I sold the put at $1.50, well, I'd want to buy that back much lower, right? Anywhere lower. I don't want to buy it back higher. So I want that theta decay to be where it starts increasing here, okay? And one thing to note also, when you get into this strategy, we're heading into this area right here. When you get into these strategies, what happens is volatility has a tendency to feel like it's holding off this line a little bit. It's not really. Theta decay is still really happening in there, but volatility pumps up those premiums. So what happens is it feels like then you get into this strategy and that volatility comes out and it rushes to catch up. And that volatility component, all that premium comes out all at once. So we want to try and capture a situation where volatility is expanding while theta is contracting, and then we take that all at once. We get the big theta component and the volatility crush happening all at once. So we want to, when we are selling puts, if you're going to sell puts or options premium, 99% of the time you want to be inside of 35 days to expiration, you know, or closest to that. 45 days I will go to also, you know, if that's the closest spot month, you know, maybe there's 15 days to expiration on the monthly before, and that puts this one out at about 45 days, then I would lean towards this 45 days, okay? A little bit further out. It may not necessarily be quote unquote the spot month yet, but I would lean towards just going out a little bit further, because if you have to go inside of like this area here, then most of your premiums already come out of that strategy. I'd rather ride it out from the 45 days to this part, all right, and take that premium run out, all right? And I almost never take the trade inside of here unless it's a loser and I'm just looking for some gamma trade going on, all right? I don't like playing around with gamma when I have a winner on, because that gamma can very quickly eat up your profits. And gamma goes with delta. Just remember that. You know, the second dollar delta tells you what the first dollar move does to your option premium. Gamma tells you when it goes with delta what the second dollar move is, right? I have webinars on all that. I don't have enough time to really probably go into all that right now, but check out some of those webinars on the Greeks to help you out with that. If you need easy ways to learn what those Greeks do and how they will help you out on a daily basis. All right, so we want to get in, you know, perfect case scenario, less than 35 days to expiration, because we get all of this volatility or all this theta drop going on in our premiums. All right. And yes, further out in time, further out on the horizon, or even out on the option spectrum, these are at the money calls and puts, as you can see. You know, if we are way out of the money calls or out of the money calls, then that theta component is going to look slightly different. But what I want you guys to take away from here is to see that theta really increases the closer you get to expiration. So when we're selling premium, we want to be inside of this area. Okay. Any questions so far? What pin app are you using to draw with? Trevor, I am so old school, Trevor. I have a Wacom. I've had this Wacom for probably 10 years and never really used it. I've decided to just start playing around with my screen here, because it was sitting out in the garage and I was like, why am I sitting on this expensive thing? Because I don't have a stand, and I built the stand I used some of my stands that I jerry-rigged to make this thing work. All right, picking the right strikes. With this one, we want to pick something where we have a high unlikelihood of getting hit, right? We're looking at the short put. We're looking at this short put right now. We're starting to lean towards this, right? Because we've checked the underlying. We know the underlying works with options. We've looked at the environment, and we have a high IV percent. All right, so that makes us automatically go, we need to sell premium. As soon as you get to this one, high IV, it's above 50, all right? Picking the right duration. Since we're leaning towards the short put, because of the high implied volatility, we know we want to sell premium. We then know we have to go shorter duration. Now we need to know, what's the right strike for this? Well, you know, a lot of people may go out there and, you know, pick support and resistances and stuff like that. I like to look at the probabilities of what's going to happen. And if we look at this as being 0, where the current underlying is trading right here, that's 0. XYZ is trading, you know, unchanged, even if it's, you know, a $100 stock, we could say. What happens is this is the call side and this is the put side. We're going to be looking at the put. So on a standard deviation curve, this is right in the middle. You know, you go to a 35 delta, and that's going to give you about this strike right here, a 36 delta. Well, we want to go, or that's not right. I don't know why I'm saying that. What we want to do is try and get outside to where the one standard deviation move is. And I just misspoke, so please erase from your thoughts what I just said. Let's see. I guess it was not using that one. I'm not going to. So anyway, we want to get to the one standard deviation. And that one standard deviation is when you add up all of these percentages, you know, even the ones that you're not seeing here, this basically adds up to 16%. Well, that correlates to the 16 delta option, which is what we're looking for. Because then if you add up all of these out this way, you know, the market can go in either direction at any given time. The market can even go down negative. The market can go against us, but you add up all of these and we basically get 84%. So 84% of the time, our underlying is going to land somewhere outside of where we are. The only thing we're concerned is from this way to here. We want the market to be somewhere in here, which means that it even went from maybe 100 to 95, right here came to 95, but we are down here at about the 90 strike, okay? So it can come all the way down negative. Despite that, we are still going to be profitable. So only a 16% chance of our underlying finishing in the money by a penny. It's only a 16% probability. Now, remember when I talked about that volatility. When volatility pumps up the premiums, when volatility comes into this market and starts pumping up the premiums in here, let me try and just erase all ink on the slide. When we see the volatility coming into this market, what happens is the premium or that volatility squishes down on this. And this actually starts looking more like this. It's a really long bell curve, really stretched out. And your one standard deviations might be way out here, right? So now if this is my one standard deviation that I'm looking to get in on, it's a 16 delta, 16% probability of success, right? Now we talked about this aspect of the underlying, when we see high implied volatility, that we see that volatility come out quickly. And when that volatility comes out quickly, when that volatility comes out, then our curve goes from that long one that we saw like that was really long and stretched out where we have the one standard deviations really far away. When that volatility comes out, we could see this actually get steeper than normal, okay? So the volatility goes from here where one standard deviation is way out here with high implied volatility. That volatility comes out. Now that one standard deviation is in here. So our probabilities incrementally increase when you're setting these strategies up with the right environment, okay? And that's what we're looking for, is the curve to go from this one up here to this one down here, or even a normal one. We just want that curve to come out, and when those premiums come out, the probabilities of that stuff happening come in. So, you know, we used to say on the floor, when there's blood in the water, that's the time to go fishing. Well, that's the idea. When there's volatility, you gotta jump on it when it's happening, because it comes out quickly and you don't want to miss that opportunity. So when premiums at its greatest, and implied volatility percent tells us when it's at its greatest, right? Because even volatility has a tendency to have, you know, extreme highs and extreme lows area, right? So it stays bound. I mean, these numbers over here will be different for every individual underlying. Like Tesla has high volatility in general, and you know, the lowest we ever see really in Tesla is 0.40, but I could probably go over to something else, and I'll just say, let's just say Lulu. Lulu, you can see its high is maybe 60. Let's look at FedEx. FedEx, perfect example. It's low, Tesla's low volatility is about as high as you would ever see in FedEx. So every underlying has its own metric that we have to watch. We don't just look at what volatility is. We need to know what this volatility is for that underlying in relation to what it's been doing in the past, because they all have a tendency to stay range bound. That's the only time that this volatility, implied volatility, is forward looking. But what I'm trying to say here is you can find what its range generally is by looking in the past, and you'll know that it won't usually go outside of those ranges by very far if it does. Okay. It's usually like a black swan kind of event that happens. All right. So know that there has a tendency to be range bound volatility for that underlying. So that implied volatility percent tells us where this current is in relation to where it's all done in the past. And that's where we want to know. When it's at its extreme highs, we want to sell premium. When it's at its extreme lows, we want to buy premium, so that if the volatility changes, it can help us out if we are directionally wrong, especially. And if it changes when we're directionally right, it allows us to get out of these strategies quicker. So my rule for this picking the right strike, we are looking for that 16 delta underlying, a 16 delta strike with a closest to 35 days to expiration. 57 is too far out. So I would go over here, and if I was going to look at, I don't want to trade. Look at this one. I would go down and try to find the one that was the closest to the 16 delta. Now, this is going to depend on your risk parameters. I usually will roll further out in a way than I will closer. All right. But if you want to go with a little bit higher risk and there's no 16 delta, and you want to go to the 22, I have no problem with that. But just know I usually roll it out to a little bit further. But I'm looking for that 16 delta put in order to implement that strategy, because as soon as the probabilities, or as soon as that volatility comes out, like we showed with the theoretical mark, if I started getting that volatility to come out by, say, that 10% that we were looking at, we could easily see the underlying doesn't even move. And, if I got this to drop by that 10% that we saw Tesla increase, which isn't, unheard of, even if this underlying did not change in price, I didn't even get this price to change over here. Look, you can see the stock price, 0 change, but we just changed this volatility number over here to decrease by 10 percentage points. And the premium came out by $1, right? Or close to it. It's not an exact scenario. It's not always exactly this, but it just gives you a pretty good idea what's going to happen with your premiums when you see that volatility come out. And that's the kind of situation we want to get into, is when premiums are at their highest, volatility starts to come out. I see a couple of real quick questions though. Curious, do the institutions sell premium on the weekly index options, hence the intraday volatility? Some will, and I have no problem if you want to trade the weeklies on this because you want to get that closest to 35 days to expiration, because you want to get that real good theta contraction. As long as the weeklies still fit that rule where we move on an underlying that's trading 160 during open market operations, I move that decimal 3 ticks and I get 16 cents wide down here in all of these options, basically here to even these options over here, the first several. Those in there are about 16 cents wide, even in the weeklies, then that's good to do. Otherwise, I would just rather go into the options that have a lot of open interest, because if I want to get out of this, I don't have to wait around. There's not as many eyeballs even in this underlying in the weeklies as there are in the monthlies. All right. Could 2 standard deviations become the future 1 deviation when the bell curve flattens? Yes, when that bell curve, that's why it's really important, Banu, to get in there when we want, if you got into this with this type of volatility, which was, let's just say it was right, it was a 30, let's just say it was a 34 IV percent. All right, the IV percent is 34. Okay, and volatility increased. Yes, absolutely. This curve is going to flatten out like that. That has a little bit of skew to it, which I've talked about in other webinars. But yes, you could see where the 1 standard deviation now is further out. And when you implemented this might only be a half a standard deviation on the deltas. Okay, so yes, you do. And that's why I emphasize when you're getting into these strategies, make sure premium is at its, near its high, or you at least expect it to come out. When I did that Tesla trade, volatility wasn't super low, but I felt that it wasn't going to go much lower. Even though a market moved to the upside, I thought volatility might come out a little bit. I felt that it was just at a low enough level I didn't have to worry about it, especially with what's going on around the broader markets right now, right? And just so happened the market came down and that volatility out spiked it. Like on that thing I was talking about with that volatility, spiking with my strategy. You know, it increased by 13%. Well, that increased my premium on my strategy by $3.30. And that was on a down move of around $2. It was a $2 move at about a, you know, about a 45 delta, let's say. So you can see the premiums decreased by less than what my, because that was $2 move. That would have only been about let's call it $1 because I don't have gamma adding into it. So $1. So my premium on my strategy decreased by $1, right? But the volatility increasing by that amount increased my strategy by $3.30. Overall, $2.30 increase in my premium of that strategy. That's why when the market was tanking, I was able to get out at a better price because my premium's jacked up. So, you know, I mean, I'm getting a little off subject with the long calls, but you can see that I just did the absolute opposite of what I'm talking about here. Here, I want that volatility to come out. So if I'm directionally wrong and that volatility comes out, I don't care. You know, if I sell these puts at this one standard deviation and the market comes down, but we get that vol crush, we get vol crush happening, then that can supersede what's happening in my directional miscalculation or my bad assumption. And, you know, our assumptions are just that, right? Everybody heard what happens when you have an assumption. Okay? I'm not going to repeat it though right now. So just make sure we try to set it up where we have a higher probability of success. All right. And with this strategy, we got to know our exit strategy. What I'm looking for here is, you can look at it for like support and resistance, but I'm looking for, if we are in this strategy, I'm getting out at 50% of my max profit. All right, so in that one, we were looking at it being like $1.11 bid at $1.37, I think, on one of those. Let's just say I got in middle of the market. I've got in for, let's just say $1.20. As soon as this decays to 60 cents, I'm out. That's where I'm getting out. I don't care if the market comes down, as long as I can get out at 50% of my max profit. Now, if you're using stocks that are less than a stock that's less than $50, you know, that 16 delta is only going to give you about 30 cents. So you're probably going to have to, you know, try and get that down a little bit more. So you might have to just look at it like, all right, as soon as it's trading 10 cents, I'm getting out. All right. And write all that stuff down on a piece of paper or in a booklet, actually, is what I use. I use a spiral notebook, and I write down my trades. When I go into this, I go, you know what? I'm bullish, and I write it down on a XYZ. All right. It meets that rule. It's the right environment. I'm going to say, you know, it was a 56%. I'm going to write that down. The duration was, 31 days to expiration. And then my strikes, I did the 16 delta. And then my exit strategy, you know, I know what I paid for it. It was $1.20. I'm out at 60 cents. Do all that. Go through that process, you guys. Why? Because I've got it written down. It's in front of my face all the time. And when it's in front of my face, it's like staring at me. You need to be mechanical. You need to follow through with this. This is what you said you were going to do. Do it. If I don't, and I just go through this and I look at it like, hey, you know, I'm looking at XYZ, and XYZ is bullish, and I don't write down anything. So I don't know why I don't know which eraser is not working. But if I don't write it down at all, then I don't know where my underlying is. I've got two different pins going right now. So, you know, Trevor was all like, yeah, he's using a pen. But now all of a sudden they're like, dude doesn't know how to use the pen because he can't get his eraser to work. All right. There we go. That was easier. So if I just do this and I go through it, oh yeah, I checked off all the things in my exit strategy, yeah, whatever, I'll get out when it's good. Then it gets to that 60 cents. You're like, I'm going to squeeze it out a little bit longer. And that's where things are going to go bad. Always stick to your plan. You plan your trade and then you trade your plan. And that's why writing it down is so important, because then you plan that out and you follow through with it. So know your exit strategy and write it down before you get in. Right? So our max profit on a short put is the premium received minus your commission. We are going for what? 50% of max profit. Oops, max. We're going for 50% of that. Stock under $50, you're going to have to probably squeeze it out for an extra nickel or so, all right? And then our max loss is limited, but it's going to feel unlimited if it goes to zero. So we used to always say it's unlimited. You are not going to take this strategy to the dirt with you, right? I mean, we know we're getting out. Wherever you get in, if you're setting it up with bullish strategies, know where your exit strategy is on the downside. If it's a technical pattern, a Fibonacci, you say it's breaking below this, I'm out, like I did with the Tesla trade. I said if it breaks below the Fibonacci, I'm out. And that's where I'm getting out. So know those things and write that down as well, so you stick to it. I said if it goes up to that 235 area, I was going to get out, and if it broke below 194.50, I was out. As soon as it started breaking below 195, I put in my strategy to get out. It went down to 196, and I got filled. That story is never going to leave, just so you know. All right, so that's our max loss. And then our break even is when that short strike minus the premium received. So if we do the $100, if XYZ is trading 100, we got $100 stock. Let's say we did the 85 puts. We sold the 85 puts for $1. Let's just say it was $1.50. Okay. Once that underlying reaches $83.50, because we get to keep this premium. Once it reaches $83.50, that's where the break even is. But this, also know, all of these are at expiration, all right? They're at the expiration area when they expire. So that's where your break even is on the last day at expiration. If it happens 2 days after you do this strategy and we get that drop, it's not going to feel like your break even is at 83.50, okay? It's going to feel like your break even starting to go higher as that premium increases, all right? So just know that the break even on the underlying is based on where it is at expiration. Pick your out, wherever your stop would be on any type of trade, that's where your out is with these as well, okay? Does anybody else have any other questions? So for me, with this one, I am itching, but I'm going to wait for Tesla. But if, say, for instance, tomorrow Tesla does one of these and I get a confirmation to the upside where it closes above that, I am going to be looking to sell some puts down here. So my next step is to go. I see it's got high implied volatility, and then I need to go to find the platform, pull it up, and then say Tesla. I think it should be just right here. Tesla, it's above 50. You can see it right there. It's actually, premiums come out a little bit. It was up in the 80s earlier today, I think. So yeah, it was up a little bit higher than that today. So I'm going to go over here and look for the 16 delta without the theoretical price. Go over to the 16 delta, and I got the 16 delta right here. So that's the one I'm going to be looking to do. So that would be the one I would sell. You know, it's a higher price stock, so you know you need to know what your tranches are to make sure you're not overweighting yourself to this particular one. But that would be what it is. And if I was able to sell this for, let's say, $4.50, if I sold the what is that? If I sold the June 160 puts, all right, for $4.50. As soon as that underlying is trading at 225, I'm going to write this down. I'm out. Okay. So write that down so you're mechanical about it and you don't let that continually just keep going. Okay. Make sure you get out for your profit target. Okay. All right, so it is earnings season, you guys. So this is what we've got going on for you guys. Is the deal is for the earnings, $36. I trade the earnings. They're fun because you get in and get out. And I have rules for earnings that you should follow. Don't listen to the talking heads, because I've heard talking heads go in there and say, we're buying calls on every stock going into earnings. Well, I showed you what happens with that volatility crush on earnings, right? And we saw percentage point drops that could not make up for the amount of premium lost, right? So on something like one of these where you get these volatility crush, this went from 81 to 49. So let's just call it 80 to 50. That's 30 percentage points, right? 30 percentage points. And when we look over here at Tesla, let's just say, if we were looking at it for earnings, the Vega, 22 cents per percentage point, all we have to do is say, well, if 30 came out of that, what's 30 times 22? 30 times 22 cents, $6 is coming out of that premium, all right, on that volatility crush. So think about how much you've got to make up in terms of dollars for this delta to make up for that, right? If I bought these calls right before the earnings, right, and I got a 30% drop in my ID, we're going to see a $6 drop in these premiums. I need at least about a $12 move to make up for that, right? So make sure you don't fall into that pitfall. Actually, not 12. That may be a $10 move. But you're going to have a massive move in order to make up for that difference in the volatility crush. So when those guys are telling you to go out and just buy calls willy-nilly, stay away from it. That's not good practice for trading options. All right. So, that tidbit alone is worth the $36. So if you guys like the way I teach, all of my courses, I try and give you little nuances to help you remember whether it's the Greeks or the type of strategy you need to be implementing, and or these little rules about that nobody's going to tell you about, the tight bid ask. Okay, those are some of the things that you got to stick with in order to be successful. If you start breaking those rules, you're kind of going to fall into the pitfalls that a lot of newer traders do. They just go to the stock. Everybody says, hey, trade that stock that you know. Well, that's not necessarily true with options, because you may know Aon or you may know AutoZone more than anybody, but nobody is trading those options, right? You can go in during the day session and look at AutoZone, and they're like $1 wide for a stock that's, maybe $200 or something. So stay away from that. And you will be much better off than trying to figure out what pricing is going to do for you. And you're going to also give up way too much edge to get in. And that means you have to wait that much longer in order to get out for a scratch. Okay. If it's only a couple pennies wide, we saw what theta is. If I have to give up, if I can find my thing here, if I have to give up 30 cents or something like that to get into a strategy, and I have theta only happening, well, this is pretty good theta on these premium. But if these were, say, $3 wide or something, and I had to give up $1.50 on the downside, right, to get in, because it's Aon or something else, AutoZone. What is AutoZone? I think it's AZO, isn't it? Let's just take a look at how wide AutoZone is. So AutoZone's $1,000 stock, so my rule is $1 wide, but you can see these are $3 wide. Right? We moved the decimal 3 ticks to the left. I need $1 wide. And these are at least $3 wide. So I would have to maybe go all the way down to $22, let's say. If I went down to $22 from $24 and I got filled at $22 to give up all that edge. Well, now think about it. This offer is not going to lockstep move down very quickly. And I have theta decay of 43 cents a day. To make up those extra $2, I got to be in this for about 5 days. 5 days just to get to break even of where my premium was, where I sold it. Now, 5 days later, the market doesn't even move anywhere. Underlying still trading right there. Well, now the offer might be at $22. The bid is like 19. So, I'm going to have to give up a lot of edge to get out. And I had to wait all of that time. It's just not worth it, you guys. Okay? So take advantage of that. If you like the way I've taught, set it up. It's over there in the chat window. We've been going back and forth in the questions box over there in the chat window. There's a hot link to this. If you're watching this on tape delay, then you're going to have to punch this into your URL right there. But for $36, you can take advantage of that. I also talk about earnings setups for the next one. So if you wanted to trade something that isn't happening right now and had a bullish market assumption for it, I've got earnings trade setups also. So setting up for the next earnings for that underlying to increase your success rate. All right. That's about it, though. I want to thank you guys all. Later webinars, I'm going to be drilling down on different option components, when and where I find those trades appropriate. Here again is the link for that offer that you'll have to punch in. It's not a hot link. And you can contact us at 310-598-6677 or trading at protraderstrategies.com. All right. And that's it, you guys. Pretty simple. As long as you guys follow those rules, you know where your probabilities are and you know what your success rate will be. All right. I hope you guys have enjoyed this. Take advantage of that link over there. Options trading around earnings is much different than just trading options on any other underlying like we were looking at for Tesla, which I might implement if we get a confirmation tomorrow. So if you're following those daily market commentaries, look for that. And outside of that, I got nothing else for you other than if you can't take that, take it easy. Love those market makers, sure says. I know. Hey, it's good to be the king and you're the only guy when you're the only guy in town, right? Appreciate it, Andrew. Thanks for the kind words, Ted. Have a great weekend, you guys. Thanks, Cam. You too, bud. Take care.